I went to the bank the other day to shop for mortgages. And to my surprise, I didn't realize there were so many different type of mortgages available in the market. However, there were two of them that got my attention. And that was having access to a 15-year mortgage, paying an XYZ amount of interest, or having access to a 30-year mortgage. And I was wondering if you can actually help me understand the differences between the two and which one will be more beneficial for me. If that's the dilemma that you're facing and you're looking for help, well, let me tell you that you've come to the right episode because we're gonna cover that today. Hello everybody and welcome back to another episode at Novarise Invest. And if this is your first time tuning into this channel, well, let me tell you, this is your channel for real estate education. So today we're going to talk about the differences between a 15-year mortgage and a 30-year mortgage and which one should be more beneficial for you. And to do that, what we're going to do, we're going to make a comparison between the two different type of mortgages, look at the numbers and help you make an informed decision as to what it's the better scenario for you. But before we do that, I would like for you to get a better grasp of one concept in particular, which is gonna help you in that decision-making process. And for that, what we're gonna do, we're gonna go straight into the board. So what's that concept I want you to get familiarized with? And that's the concept of amortization. Now, I'm not gonna overcomplicate this and use fancy finance terms and stuff like that. Amortization, let's just define it in plain terms, it's just simply a way to distribute all the interest payments along the life of the mortgage. So let's say, for example, you have a 15-year mortgage versus a 30-year mortgage. So in essence, the way the interest rate works is that it will follow this pattern. It will start really high and then it goes all the way down in the bottom. So what does that mean in plain terms? It means that usually for most mortgages, not all, but for most of them, the first half of the mortgage is what's going to contain the highest amount of interest in your mortgage payment. So half of it will be 7.5 and half of it will be 15 years. So if you have a 15-year mortgage, during the first 7.5 years, that's when you're going to pay the most interest out there for a mortgage. And if you have a 30-year mortgage, that means for the first 15 years, you will be paying the most amount of interest. Now, what does it mean in layman's terms if I really have to narrow it down to numbers? Well, it just simply means like this. Let's assume your mortgage payment is $1,000 a month. So out of this $1,900 will be going to interest payments and only $100 will be going towards the reduction of your debt. That means for the first 7.5 or the first 15 years, your $1,000 mortgage payment will have a $900 interest going towards the mortgage and only $100 to reduce your principal payment, to reduce your overall debt, whatever the amount is that you borrow from the bank. So it is very important that you keep this into consideration. And in a minute, we're gonna see why. And for that, let's jump straight into my computer. And here we are, as promised. So we're taking a look at this calculator right here that's going to allow you to do a comparison between the numbers that you will see on a 30-year mortgage versus the numbers that you will see on a 15-year mortgage. Now, this tool is going to be made available to you. All you got to do is just to go down on the description box and just simply click on the link down there. And that's going to take you straight to this calculator right here. Now, this calculator, it's free, right? It's available for you. And all you got to do to access this, it's by simply coming here and making a copy. And then you can name it whatever you want. So you can name it John Doe copy of 15 versus 30-year mortgage or something like that, right? And then you're going to click on OK, and that's when you're going to download a copy. You will not be able to make edits directly into this sheet in particular, because otherwise it will get very messy having thousands of people accessing this tool at the same time. So in order to make this better and more private for you, because I'm sure you will not want to share your numbers out there with other people, what I decided to do is to give you access to this calculator through the steps that I just follow. So you're going to download a copy just for yourself, make a copy, you're going to download it, and it will be private. It will be for your own use. Now, the instructions are actually left in here, so make sure you read those as well. And it's basically the same thing I just told you. And I'm adding here a friendly reminder that we will not respond to requests for edits. We created a episode similar to this one for another calculator for a mortgage payoff using credit cards, and we've got tons and tons of people asking us for requests for edits, even though the instructions are right here telling you that you will not be able to make edits in this page. So no exceptions will be made. So please pay attention to what I'm saying. If you want to get access to this tool, it's very easy. Go down to the description box, and then once you are able to see this tool, all you got to do is just to make a copy, and voila, you will be able to make the changes yourself. Okay, so now let's just play around with these numbers right here, right? So what I'm going to do in order for you to see things clearly, because sometimes we do have people who are tuning into our channel through their cell phone. So I want to make sure that you can actually see, in fact, what I'm doing here. So we have a 30-year mortgage calculator right here, and you're going to see 3 cells where it's requiring you to enter the values. Everything else, you won't touch it, okay? You'll see a bunch of zeros here, but don't worry. Once you start punching in the numbers, you will see the magic happen in the calculator. So let's just use $200,000 as an example. For a loan amount. So you went to the bank and the bank approved $200,000 for you to use, right? And let's assume that the interest rate that you have is 3.5. You have excellent credit and we're at historical low rates, yada, yada, all good, right? Now, this is the part where it gets tricky for some people. I wouldn't say most, but if you take a look at what the cell says, I want to know the term, right? And the term, as part of the instructions, is saying that you need to take the years and multiply that by 12. Why multiply that by 12? Because the payments that you make are done on a monthly basis. So knowing that you have a 30-year mortgage is not enough. What you need to do is to take those 30 years and turn those into months. So what we're going to do is we're going to take 30 right here, so you can see the calculator, and then we're going to multiply that by 12. Why 12? Because we have 12 months in 1 year. So that means you're going to have a total of 360 payments, right, for your mortgage. So what you're going to do, you're going to come in here and you're going to type in 360 and voila. So that's your mortgage right there, right? And that's your monthly payment. $870.41. And this number only includes principal and interest. What's principal? Is the amount that you're contributing towards the debt. So that way you can start reducing it as you move along in the mortgage, right? This number does not include property taxes. It doesn't include insurance, which I know is usually included in the mortgage. We're not going to go over that today. The purpose of this video is just to show you how the actual loan will look like in terms of principal and interest, right? Now that you make your entries, you already got all of this in here, and you will see a breakdown for, all 30 years. And I know these numbers are overwhelming. Here are all the 360 payments. But trust me, we're going to go somewhere with this. So first things first, I want you to pay attention to this, right? So on the first payment that you make on your mortgage, right? $870, I want you to take a look at the breakdown. So once again, the principal is what you pay back to the loan to help you reduce whatever amount of money you own. And then interest, I mean, that's pretty self-explanatory, is the interest that you pay for the bank, because the banks are here to make money, right? So you're paying $870, and now you get to see what I mean by amortization and why that concept was important. Because out of the $870.41 that you're paying, you are only allocating $328.75 back to the debt repayment, to the principal. And out of that, you're paying a whopping $541.67 to your interest. So the breakdown is kind of like, wow. So during the first couple of months, or during the first half of the mortgage, better said, a big chunk of your money is going to go towards the interest, just like I said back then in the board. But if you were to go down to the middle of the mortgage, what's the middle of 360? 180 payments, right? So we go down to 180, and then you will see a different allocation. So you're still paying $870.41, but look at the distribution now. We're talking $533.48 going towards the principal reduction, to the reduction of the debt, and then only $336.93 going to interest. Now, I understand $336.93 is still a lot of money. However, when you compare these two numbers, you can't deny that you will be glad to say that, hey, now at least I know that more money is going to go towards the principal. And then as you scroll down and you head towards the end of the mortgage, you're going to see a reduction of an even further amount. Now you're going to see only $78.62 allocated towards interest rates versus $791.80 going to principal. And once you reach the end of the mortgage, on payment 360, then you will only see that the only amount that's going to be allocated to your interest will be $235, and then $868 will be all allocated to the mortgage, right? And this is important, okay? Because now the next thing I want you to focus on or pay attention to will be these two rows right here. So if you choose a 30-year mortgage, you will be paying a total of $113,348.55 just in interest, okay? In 30 years, if you pick a 30-year mortgage, you'll be paying $113,348.55. But the numbers don't end there. Remember, you borrowed $200,000. So that means you also have to include the $200,000 in the equation, which means that in the span of 30 years, you took out a loan of $200,000, but you ended up repaying the bank $313,348.55. How did I get this number? Very easy. I added the debt of $200,000, which is what you originally borrowed, plus the interest that you pay, which is $113,348.55. So that's the total cost of your mortgage if you were to pursue a 30-year mortgage. Now, let's just look at a comparison and let's slowly scroll to the right and do the numbers on a 15-year mortgage. Now, for this calculation, we're basically going to use the same numbers. We're going to use the debt of $200,000. We're going to use the interest rate of $325. The only thing that will change will be the time. Instead of 360, we're going to do the math for a 15-year mortgage because that's what we're looking to get here. So we'll come in here. We're going to enter 200,000. And then on the interest rate, we're going to do 325. And then on the term, what we're going to do, we're going to take 15 years times 12 months, 180. So what you're going to do is just to type in 180 and voila, the magic happened and the calculator worked on its own. Now, before I proceed, I know some of you have offered to help block the sales, lock the sales, whatever you want to call it. I really appreciate the offer and especially appreciate it because I know you really want to contribute towards the mission of Novarise. However, Google Docs does not allow us to do that. It's something that can be done on a regular Excel program, but we chose not to use Excel because we wanted to make this tool available for everybody. And it can't get any easier than just simply opening your own Gmail account, which is free, and then going through the step that I just showed you to access this tool. But I truly appreciate that. Okay, now back to the calculation. So we talked about 200,000. 325, 180. These are the only 3 cells that you're going to touch. Well, 6 in total because we're talking 3 cells here and then 3 cells here on the 30-year. Okay, so you enter these numbers and now you're going to see that the monthly payment went up. And now the monthly payment under a 15-year mortgage is going to be $1,405.34. However, I don't want you to get so hung up on that. Yes, I understand that the monthly has gone up. However, you're going to pay off your mortgage in 15 years. And here's what I want you to pay attention to. So when you come in here, you're going to notice that out of the payment of $1,405.34, $863.67 is going to go towards the principal, towards the reduction of your debt. And only $541.67 is going to go towards interest. Now, don't get me wrong. I know $541.67 is still a lot of money. However, you can't deny that you're actually glad to see that, hey, out of this whole amount, more money is actually going towards your principal as opposed to the interest. So those are some of the things that you want to take into consideration. So what I want to do right now is actually compare these two calculators side by side so you can see both numbers. Okay, so we have a 30-year mortgage and we have a 15-year mortgage. All variables are the same except for the term. We have a 15-year mortgage, so that makes it 180 payments. and we have a 30-year mortgage on the left side for 360 payments. So first thing I want you to pay attention to is, of course, the payment. So with a 30-year mortgage, you're paying $870.41 on a monthly basis. And on a 15-year mortgage, you're paying $1,405.34. Now, I understand it's more money. That's why we have options here, right? That's why I'm presenting both options, so that way you get to decide what is better for you. Some people decide to just get it over with and not deal with that and just choose the highest monthly payment, because that will allow you to reduce the debt faster, which means you will be acquiring more and more equity as the years go by, because you're making more aggressive payments. However, some other people are afraid of committing to such a large amount because you truly don't know what could happen down the road. So therefore, they want to have the flexibility of choosing a mortgage with a lower monthly payment. And then maybe if they have enough money around that time, they can actually add more to their monthly payments and just pay off the mortgage faster. So that will be completely up to you. But just keep in mind that when you do that, when you select the lower monthly payment, you accumulate less equity because of the way it's broken down on the amortization, right? Which takes me to point 2. So if you were to compare a 30-year mortgage, out of the $870 that you're paying right here, only $328 is going towards the principal, and the majority of the money that you pay, it's going towards interest, as opposed to on a 15-year mortgage, is actually the other way around. Because out of the $1,405 that you're paying, a big chunk, $863, is actually going towards the principal, and less of it is going towards interest. Definitely something that you have to keep in mind. Now, the third point I want you to pay attention to are these 2 rows right here. So if you choose a 30-year mortgage, look what we have here, right? So the total interest paid in all 30 years will be $113,348.55. However, if you take a 15-year mortgage, look at the amount of interest that you will be paying. It's reduced. Now it's less, a lot less. We're talking about $52,960.76. If I were to take this calculator, let's just see how much are we talking about. So $113,348.55 minus $52,960.76. We're talking about a $60,000 difference. That's how much you're saving in interest if you choose the 15-year mortgage, right? And then if you were to add all the numbers together, of course, you must consider that. Out of the $200,000 that you borrow plus interest, you'll be paying back the bank $313,348.55. Wow, that's a lot of money. But if you were to come in here on the 15-year mortgage, if you borrow $200,000, right, from the bank, including interest, you will be paying back the bank $252,960.76. So this is definitely something for you to consider. It's very important. At the end of the day, that's why we're doing this, because we want you to take this information and make an informed decision for you, right? You have to evaluate what your options are. That's the beauty about shopping around for different products, shopping around for different type of mortgages, because every need of every person is different. Which one would you prefer? Let me know in the comments box. Would you prefer a 15-year mortgage, or would you prefer a 30-year mortgage? And that was pretty much it. I truly hope you find this episode very valuable. And if you did, do not forget to share the love and share this content with other people who you think could benefit from today's content. And while I still have you here, do not forget to check this episode right here. That's going to help you complement everything you've learned today. And until then, I will see you guys next time. Take care. Bye-bye.